and welcome to this DerivSource video. I'm Julia Schiefer, the founder and editor of DerivSource.com. Now, those of you watching will be working in OTC derivatives already, so you'll already be well aware of the regulatory reform in this industry that's been taking place for the last several years and is really still ongoing. Now, today in this panel, we'll be highlighting some of those regulatory changes, such as the move to central clearing, new trade reporting, and electronic execution requirements. But more importantly, we're going to be talking about the challenges that market participants face in light of this regulatory change. And what we really hope to do today is to give you some insight into where this market is evolving, how it's evolving, and how you can make changes to your business to take advantage of how this market will be changing in the long run. Now, the first topic I really want to discuss today is the futurization trend. Swap futures haven't really taken off despite various different exchanges having offerings, especially in the US. Ricky, starting with you, why haven't swap futures gained any traction?
Several reasons, Julia. I mean, the hardest thing for any exchange to do is launch a new contract and ensure its immediate success. I think where swap futures falls down is there's no currently, I think there's a lack of, I wouldn't say accurate pricing, but I don't think the real capital cost of OTC clearing is yet present in bid-offer spreads in the OTC space. Therefore, the swap that's where the advantage for the swap future would occur, insofar as it's transparent, it's on the exchange, it's liquid, and there's a fairly tight spread because it's a future rather than an OTC product, or rather than the OTC underlying. But the trouble is that liquidity is not yet there. So the buy side do not yet have a requirement to use those products because the sell side aren't yet showing that differential. I mean, the CME future in the US is a great example. I think open interest is between kind of 5 and 10 yards, and Ray Khan of Barclays recently said that from an OTC perspective, they're clearing 100 billion a day, so 100 billion of OTC notional in a single day. So the CME swap future, which is probably one of the more successful products, is still a very, very small portion of the market.
Okay.
I think just to add to that, from a buy-side perspective, it's very difficult to push clients into products without the liquidity being there. Yeah. To Ricky's point, we don't want to be a significant portion of the open interest. Yeah. We just can't afford to be there. We need to know that we can get in and get out again. Yeah. So.
And that's a big concern for the banks as well. I mean, you know, they in Risk Magazine last week, they stated exactly that. I can't actively participate in these contracts when I am a large part of the market, and there are also Volcker implications for being such a large part of that market.
Now, do you think swap futures will take off a little bit, going back to what you alluded to in terms of timing, when the mandatory EMIR clearing deadline comes into force, or is it really reliant on liquidity kind of being up there before people will start adopting these instruments?
I mean, it's interesting because for swap futures to be attractive, the underlying, so the actual OTC instrument itself, has to be accurately priced in terms of capital cost. That's where you will see, you know, the differentials occurring in the marketplace between cleared and non-cleared swaps, and also between swap futures and the underlying product. One area of concern is the SACCR proposes to change the 2-day VAR for a swap future to 5 days. And should that be the case, then realistically, that swap future kind of loses its, its slight advantage.
Okay, so things might be changing in the short term for that.
Absolutely,
We'll see how that develops under BCBS IOSCO. Any other alternatives kind of that you guys want to mention in terms of other products that might be launching similar to swap futures that you've been seeing or that you find particularly of interest?
So there are two elements to that for me. You've got the derivative market element of that. So you've got the, let's say, the GMEX constant maturity future, for example, which is a great product. It's a swap future, and it's probably the closest you could get to a proper interest rate hedge, because you can drop OTC hedges and use futures, but you're always going to run some basis. There's going to be an element of basis risk. There will be a gap. The CMF is probably the closest match to that. But again, it's the chicken and the egg thing. It's the liquidity. You know, it needs active participation from the buy side, market makers, and sell side. Away from the derivative space, then you know you can hedge duration risk with bonds. You can hedge inflation with index-linked gilts. And realistically, if you're looking at the costs of clearing derivatives,
exactly,
those become very viable alternatives.
Yeah.
Now, we've talked about swap futures and the futurization trend. One of the big challenges that we face in the industry is the cost of all this regulation, and particularly the cost related to clearing and the new collateral requirements. So focusing on that and going to you, Eugene, first, how are you kind of managing this uncertainty with the cost of clearing, and how is it impacting your business?
I mean, I think it's obviously an interesting one because people talk about the costs of regulation and the cost of clearing. I mean, there is a significant cost around regulations as a whole in terms of all of the new regulations that have been launched over the last few years have had to bring about significant changes in an organisation, be it process, be it infrastructure, and that in itself has had a cost to an organisation, which is very much a sunk cost. And then if you then look at the clearing side to it, I mean, as a clearing broker providing a clearing service to our clients, there's two fundamental costs for providing that service on an ongoing basis. So ignoring the initial setup costs. On an ongoing basis, a clearing broker has two costs. It has its processing costs. So it has to have people and it has to have technology in place. So that's your operational side to it. And really clearing brokers try and factor that in terms of maybe a per ticket fee or monthly minimums, those types of components. And then there's the other side, which is becoming much more under the focus at the moment, which is, should we say, the limited resources utilization. So the usage of a clearing broker's balance sheet or risk capital. And that therefore has to be correlated much more to the risk and the notional that the client is bringing to the clearing broker, and hence the associated costs with it. So the operational costs, I think, are now starting to bed down. Clearing brokers know what it costs to process a ticket, or they know what it costs to have an infrastructure in place. So more and more now you're seeing clearing brokers being quite well aligned on that. But the biggest issue we really have is around that limited resources. How do you price in the risk capital element in terms of the default fund contribution? Everybody will have their own internal model and their own interpretation of that. And similarly then the leverage ratio, which is another big factor, is whilst it's very clear the costs that need to be associated with that in terms of the add-on, in terms of the notional, and then the amount of margin and the netting, etc., that you have in place, there is still uncertainty as to whether or not that is going to be the rules in the future. So there you start to see a bit of a difference between some clearing brokers will be conservative and they'll price the entire amount in today. And other clearing brokers will say, we will price in what we know today, but we be very transparent with our clients and say, should clarity come in with the regulations, we will have to change our pricing. And I think that's where you're seeing a real issue in the costs, because therefore clients and clearing brokers have an unknown around what are the costs going forward. And that will then create delays for incentivizing people to want to clear today. And so suddenly you move away from incentivizing to your effectively the carrot and stick scenario. It becomes more of a stick situation in terms of the regulations will become mandatory, and then the clients will have to start to clear. And obviously Barry can comment on that about clients' readiness or willingness to clear.
Yeah, I think there are two things to that. The first one around the costs. Trying to have a conversation with your underlying clients about costs when you can't be precise is very, very difficult. So saying you need to move into clearing, we think you should be doing it now, how much is it going to cost me, is a very difficult conversation. Something I did see yesterday, though, that I think may help, certainly on the leverage ratio side, was Kay Swinburne, who's one of the prominent Euro MEPs in this area, came out and said that Europe may go it alone on recognising segregated margin in terms of the whole capital cost. Clarity around those elements is really what we need, I think. So.
And do you think, looking ahead to 2016, that clarity will kind of be a little bit more well known or come to be?
I would defer to Eugene on that. We're just, we're at the back end. We're not involved in those conversations.
I think there's two things to that, unfortunately. There's clarity, which is great, but then there's how quickly can you implement the changes, which takes a lot longer. So you might have a lot of people arguing about certain elements of the regulations and saying that they need to be amended. However, whilst there might be an industry consensus on that, the timelines to do that, though, can still be 2 to 3 years. So that, that's the problem that you have. Therefore, we're in a state of influx. Let's just say mandatory clearing comes in for at least Category 1 and Category 2 next year. We're in a clearing environment. We're in a mandatory clearing environment, and yet some of the costs around that will be changing in the future. So you have to price for today, hoping that they're going to go down for the future.
I was just going to add to that proposed leverage ratio change is so crucial. It really is very crucial.
And we've already seen some of the impact indirectly of the cost, to operate in this industry, with a lot of client clearing providers or brokers already exiting. So do you expect because this uncertainty is not going to go away anytime soon, do you think that maybe we'll see more exits or any other kind of major changes will take place as a result?
I mean, we don't have a crystal ball, so who or should anybody exit in the future, who knows? But and obviously it's very difficult to comment on why the current leavers of the industry left. But every institution has to look at its business proposition and where it fits into its organisation, and I think that's very important. And also how much balance sheet it has and how much risk capital it has. I think clearing has a place within clearing brokers to be able to provide to their clients, but the concept that they can provide it to every single client, I think, is where we're going to run into problems. However, I also do think that everybody always talks about levers. There are entrants coming into the market. They might not be coming in with lots of media attention to it, but there are smaller institutions that are starting small. They might say, well, actually, we're going to look at some of our subsidiaries first. We're not necessarily going to go for the intragroup exemption. So let's start small. Let's become familiar with the process. Start with all of our subsidiaries. Once that becomes a robust process, then to grow that out to the outside client base. So I think we are going to see entrants, as well as potentially we could see some more people leaving the industry.
I think also it's worth mentioning discussions in the industry around potentially self-clearing.
Mm-hmm.
So I appreciate we haven't got to a place where all participants are necessarily comfortable with how that might work in practice. But there's certainly, I would argue for certain players in the market that's potentially a solution. And essentially in that scenario you might see either banks provide, the existing clearing members providing more of an agency service where they're doing the heavy lifting and stuff in the background, but avoiding the capital costs.
And that's definitely a conversation I have with my buy-side clients, the kind of larger pension fund managers as well as larger asset managers, and there are two flavours of that. There's the self-clearing as a whole. There are very strict criteria at a CCP to be able to do that. I mean, from a CCP's perspective, the more participants you have within the CCP, the more diversified the risk, and that's a good thing. But it's not necessarily the case that, well, in the case of an asset manager, for example, they're managing those assets on behalf of other people. So do they have the cash to contribute to the default fund? Do they have the equity capital behind them in the first place? That's not necessarily always the case. We have a couple of, let's call them indirect, so at Eurex you've got the repo CCP and the securities lending CCP, and that's accessed via a principal relationship between the underlying investor and the CCP, with, as Barry alluded to, the clearing member doing the heavy work in the background, so the default fund contribution and any DMP responsibilities still sit with the clearing member. That's something that we're looking at potentially extending into the OTC market as well, so that if required, we can provide clients that access. Because one very important point to remember is, and Eugene alluded to it earlier, if you are a client that cannot find a clearing member, and you cannot trade a mandated product. So in terms of if you're that small and you need to hedge risks using OTC derivatives, you're a small pension fund, you do 10 trades a year, in terms of ticket fees, etc., and the balance sheet that you're going to tie up of the bank, you're not an attractive proposition. Are you going to find a clearing member? There's a chance that you won't. So does that then mean that those smaller pension funds have to step away from derivatives as a whole?
It's not just pension funds though, Ricky. I think you'll find a number of the building societies struggling to get coverage.
Yeah.
And that has direct consequences on the general public in terms of that they wouldn't be able to do fixed rate products. Yeah. So fixed rate mortgages, it's going to be much more difficult if building societies can't get clearing brokers. So.
Yeah, that's a great example.
No, so we have a potential new option coming out with this uncertainty with clearing, with self-clearing, but it seems to me from what you've described, Ricky, and the whole panel's described, that might not necessarily still fill the gap, as we've alluded to, where some of the firms might still be too small or might not be able to do that.
It's inextricably linked to that capital point though. If we solve the capital issue, then I think this potentially exactly.
It does solve a lot of issues, and as well. I mean, so the regulators intend well, okay, but they want to deleverage the derivative marketplace. But by deleveraging, you actually reduce liquidity. By reducing liquidity, any good responsible CCP is going to increase their liquidity add-ons within that particular product. So you've got a contracting market with increased costs. That's not going to end happily.
No.
Yeah. Well, with the leverage ratio and kind of capital requirements, do you foresee changes taking place along the regulator lines in the next year?
Well, it's, as I said, I think the comments from Kay Swinburne are particularly interesting, slightly exciting, the fact that she was alluding to the possibility of Europe going it alone in terms of recognising that.
You've also the CFTC, Massad's come out with exactly the same comments, and not about going alone per se, but saying that there needs to be a change to the way they are written at the moment because they penalise should we say, the process that is trying to address what the regulators have sought to solve for in the first place. Right. So again, back to that point, I think we will get more clarity on that, but the timelines around that is where we won't have absolute clarity on.
I think there's still a lot of pushback from the central banks, though, at the moment in terms of relaxing those rules. And I think that's going to be crucial to any changes that we get.
Now, we've kind of covered some of the challenges already in terms of the cost and the capital requirements, but one of the major kind of byproducts of this regulatory reform, that we've been undergoing for the last several years has been the complexity. Now, as I said, the capital and the additional processes required are two of many of the new challenges. Barry, over to you. In terms of the complexity and that's inherent in the infrastructure now, what do you think are some of the other unintended consequences that we haven't already outlined?
Well, I've made this point on a number of occasions, Julia, but to my mind, one of the things that my area does is counterparty risk. And when you look at clearing fundamentally, what's one of the aims? One of the key aims is to reduce counterparty risk. When you counter that with the complexity that we are having to build into our systems and processes and everything else, operational risk very soon becomes counterparty risk when things break. So I think we will get there. I don't think we have a lot of the systems and processes necessarily that we need today, particularly on the buy side. Clearing, it's still a relatively new concept, and there's still a lot of work to do, I think.
But I always think everybody uses the word complexity around regulations, but kind of to your point, I think you do have to break it down into two pieces. You have the derivative elements to it, the getting that transaction into the clearing house and clearing that. I actually think that that is reducing complexity because that is becoming much more automated. You're affirming trades up front, so there's no back-end operational reconciliations and communications with your counterparts to agree the terms of the transactions, etc. That's all done up front. It flows from an automated perspective into the clearing house, depending on the buy side or the other members, how automated it is internally. But I would generally argue that is quite automated. However, the complexity comes on the collateral piece.
Exactly.
Right? That is the new component to all of this, right? So you've reduced a lot of operational complexity around the derivative aspect, but the collateral piece is what's new. Again, dealers have been doing this for a long time, but maybe smaller counterparts have not been used to having a collateral management, or if they have, they might only have been doing weekly type of collateral movements. They'd have had minimum transfer amounts in place. Suddenly they realise they need to have funding capabilities, not just same day, but same day, multiple times the same day, potentially, depending on the relationship with their clearing broker, etc. So it's those elements that are adding the complexity into it.
But you've also got the bifurcation between cleared and non-cleared. If we could put everything into clearing, I agree it would be much simpler. But we can't do that. We still have to operate the bilateral arrangements that we operate today. In fact, we have new rules coming next year which, again, further complicate the existing arrangements. And to my mind, it's the bifurcation. But I totally agree, it's the collateral process where the real issues are.
But I think there's been some excellent innovation around that space. Yeah. I mean, if you look at, so, you know, as Barry alludes to, his trader sits down and he wants to put a swap on. So he's got to look at the best bid offer spread. Where's the best place to clear this swap? How am I going to fund it? And all of that is now a pre-trade consideration. Incredibly difficult to do. And there are companies out there that have developed those pre-trade analytic capabilities. And there are companies that have developed the post-trade cost of funding capability. And you can now have all of that in one place. Yes, it's going to cost, but in terms of what that does for your business, as Eugene says, you know, once this is in play, when you futurise a very cumbersome OTC trade flow, it actually will work very, very well. And there will be efficiencies and cost benefits and savings eventually.
Well, I think the other thing is you also have to look at the dealing complexity as well. If you're a global asset manager and you're bulking up orders across a number of different accounts with no equivalence between the EU and US in particular, the complexity you introduce to dealing, oh God, that's a Dodd-Frank one, that's a EMIR one, that's a something else one. The risk of getting something wrong is very high, I think.
Well, it's a brilliant point, because if you can't block trade across your global mandates, you've got to go here for one price, here for a different price. And in terms of best execution, how do you, and if you're spreading that across your clients, how do you justify those differentials? So it's a brilliant point.
Well, I think there's a lot of development in the collateral space with various utilities, or whatever you want to call them, hub-based systems that are out there that aim to address various different problems of the life cycle and address the complexity that we've alluded to that has been built into the system as a result of this regulatory reform, both cleared and uncleared. But one of the questions that I'm still unsure about with the complexity is that we have the complexity that we've already described internally and with the market in general. But what about the end users who might not necessarily have the volume to justify the cost to either do the internal spend, or maybe they're not even able to join some of the utilities that are out there that might be able to address even just part of the process. So do you think that these costs and this complexity will eventually drive some of these users away?
I think even before you get to that, Julian, in terms of the conversations with underlying clients about the fact that, for example, EMIR applies directly to them, not to us. The ability of clients to get their heads around the fact that these are their regulatory obligations and getting that across to them in terms of, and then the questions that come back, well, what are you doing about this? What are you doing on reporting for me? What about that? How do I know you're meeting all my regulatory obligations? I think that's the first hurdle that you have to get over. It's a relatively new concept to most of our clients. I mean, if you look at MiFID, that applies to the asset managers, to the banks, etc., not to the underlying clients.
And just to add to that as well, even when you've managed to explain that to your clients, you then, as a large asset manager, Barry, will have multiple clearing members, and there's no guarantee that those clearing members' operating models will be the same. So therefore, you may have a view of what your optimum clearing strategy is, but you're forced down different avenues. So how do you determine which clients, and that's a difficult challenge as well.
So the education of clients, their kind of lack of understanding that that they need to comply with this regulation, and thus you need to satisfy their various requirements if they do want to go down different avenues.
There's quite an amazing statement to make, though, if you think that the talk about the regulations and everything, what are we now, 2015, and this started in 2009.
Yep.
Okay, there was very little development maybe for the first couple of years, but for the last couple of years, there's been a lot of development, a lot of information out there. As a clearing broker, we distribute a lot of information. As a clearing house, you distribute a lot of information, and yet we still hear that maybe some of the end clients still are not necessarily aware of the full impact of the regulations and certainly not preparing for them. I mean, I've spoken at maybe some conferences before and just done a very standard straw poll of hands, and it's been astounding to see how many people have not really thought about preparing for the specifically the clearing regulations, or if they haven't gone forward and then actually selected a clearing broker. And I think that that's an interesting one. So I think the discussion about whether or not people are going to drop out of the market, they're going to decide to hedge, not hedge, etc. I think that's still a long way in the future, because people have not, those who know that they are going to continue to do derivatives have already kind of made that decision. Those who, and there is nobody who decided they're not going to do derivatives, they just haven't thought about what they're going to do yet. And so I think there's still a period of time before we actually see the real results of whether or not people are withdrawing from the market completely.
One of the things that I would highlight around clients is effectively they are now being regulated by the FCA, whether they recognise that or not. And a couple of years ago at a conference where somebody from the FCA was speaking, I stuck my hand up and I said, can you please tell me if you are going to reach out to these clients, the underlying entities, and tell them that you are now effectively regulating them, or are you expecting us to do it? And I think I caught the person on the hop, to be honest, but the answer I got back was, we're expecting you to do it. So again, we're acting as a conduit to explain the regulatory obligations to the clients rather than the regulator.
And just coming back to a point that we made very early on, is this uncertainty. So how do you communicate the cost to clear, even some of the implications of these regulatory requirements, if we still don't know exactly what they will be, or they might be changing. Hopefully in some accounts they will. So again, that uncertainty seems to be a problem with the end users. To your point, Barry, if you're expected to communicate with them, how, are there other ways that you would encourage end users to kind of, make sure they're up to speed, other than relying on their asset managers to keep them up to speed?
To be fair, in actual fact, I probably overstate that to some degree, because some of our clients are already FCA regulated or PRA regulated, but the smaller ones certainly wouldn't have been previously.
And there are huge legal ramifications to that,
exactly.
because if one of your end clients in 5 years' time gets fined by the FCA for something that they haven't done, they could well turn around to you and say, Barry, why didn't you tell me about this? So that's a huge responsibility for the asset management community.
Well, I think we have, and I imagine every other asset manager has communicated to those clients what the majority of our clients sit in Europe, so we've communicated the EMIR obligations to them. We've told them what we're doing. And please come to us if you have questions. But that's about as much as we can do, I think.
And ultimately, it's their responsibility to
Yeah.
take action. So, I mean, you can
Yeah.
communicate with them,
Yeah.
but they have to be held accountable.
Yeah.
But I think back to your point where you said, well, maybe the costs aren't fully known. We do know it's going to happen,
Yes.
and we know who it's going to impact, and we know who needs to get ready. So you can't hide from those facts. They're very clear facts. So it's more about encouraging your end users, your end clients to engage sooner rather than later. Because if we have anything to use as experience in the US, when we went through kind of like the second and the third phase of financial counterparts in the US, there was a huge rush right at the end. In the last, literally in the last 24 hours or so, you hear stories of people working all night, setting up static data in their systems, etc., to be able to be ready on that Monday morning. And I think that's the message to a client is, yes, we can be, every clearing broker, every clearing house, etc., can be as open and transparent about what their costs are today, what the known unknowns are, and maybe even the degrees of how those known unknowns could the known unknowns could change. But actually encouraging to start sooner rather than later, because it will take time. And not to scaremonger so much, but as we see clearing brokers start to review their client base and review who they're giving their clearing services to, it's kind of a bit, first in, or last in, first out type of thing. You want to be there, you want to be using the services of a clearing broker, you kind of want to be allocated a proportion of that clearing broker's resources so that you know that when it is time to act, you're good to go.
Now, we've talked about this already, systems and internal technology, but I want to focus on this very briefly again because at DerivSource we have a lot of operational managers who ask questions about technology, middle, back office, collateral management, etc. So do you think that the systems are fit for purpose currently to support all the various changes? I know the answer here, but where are we with building these systems to support what they need to?
I would argue there are so many to-dos at the moment that it's a case of prioritising things in order, that, in the order that you think is most appropriate. We cannot, nobody in the industry, no firm, as far as I'm aware, has sufficient resource really to implement everything at the same time that we're looking to do. So I personally think there'll be phases. The banking side of the industry it always leads on the technology, and the buy side systems tend to be that bit behind. Arguably, to Eugene's point, we've known this was coming for some time, so it's very difficult to defend the fact that certain things haven't necessarily progressed as far as they should have. But I think there's just such a tsunami of regulation. Yeah. When you take it all together, MiFID 2, EMIR, the other global pieces that sit behind the derivatives piece, UCITS 5 coming down the track, AIFMD, firms are just overrun with regulatory to-dos, which in a number of areas conflict or don't align. So, for example, in terms of MiFID reporting, MiFID reporting for derivatives is different to EMIR reporting for derivatives. I find that completely crazy. I know they're trying to achieve slightly different things, but surely we can come to a common standard where we can have one set of reporting that meets both requirements. It's just the sheer scale of the things we're being asked to do all at the same time, I think.
So I mean, I guess the short answer to your question is no, and I think you knew that, right? Is everything fit for purpose? No. And again, it's been for a variety of reasons. Barry said, well, the buy side has known about this for a long time, but they haven't done anything about it. Again, that's a bit disingenuous. They've been doing.
Wouldn't go that far.
They've been doing trade reporting or things like that.
We've done an awful lot.
But they've had to focus on trade reporting. So that was a big thing of last year, to be ready and up and running. You know, you had 2 stages of that. So that was a big focus. And I think that if we look at, if we look specifically on the clearing side, I remember being at a conference 4 years ago, 4 or 5 years ago, when clearing was just starting to come, and there was somebody up on the panel, and somebody in the audience asked, he said, how quickly can you get somebody up and running for client clearing? And this person said 4 weeks. 4 weeks to get them up and running for client clearing, and it kind of explained why, and I think everybody said, no, that's not reality, that's a theory. But I think the point is that actually you can get ready for some of this very quickly. Collateral management. I know this is difficult for maybe asset managers, but on day one, everything gets just done in cash. Now, there needs to be ways to actually generate that cash.
At the same time, the banks are pulling out of the repo market.
Exactly, I know.
So
But I guess that's not about systems fit for purpose. No. But from a systems fit for purpose, I think you would do it in stages. You'd start off, and we see this in reality. Our clients start first to just get familiar with a daily process and all of those elements, and then the easiest way to move collateral around in those days now is cash. So you move cash around. As they become more sophisticated, then and their systems become more fit for purpose, then they move into more non-cash collateral. So there's a lot of work that still needs to be done around that, and there's a lot of manual processes, even within dealers. You know, let's be honest that dealers lead the way. Yeah. Yes, they do, but dealers also want to be first to market, and sometimes to be first to market, you do put in some manual processes and then you automate them at a later date. And I know that in actual fact, the delays in the regulations, whilst a lot of clearing brokers have said the delays in regulations have been detrimental to their business case proposition, the delays in the regulations have also allowed dealers to maybe review their processes and actually make them more fit for purpose for when the volumes finally come in, because actually they really tried to put together something belt and braces in the early days to be able to offer the product, whereas then obviously the take-up wasn't as strong, so they've now been able to enhance their process and systems.
I've heard similar things with all types of market participants, where they might be building a system to meet a requirement now with, say, EMIR trade reporting, but then MiFID 2 trade reporting comes along, and they might do, for lack of a better term, a Band-Aid approach, where they try to attach something else to it, but they know that in the long run it's not going to work. It's not going to address all the reporting that they will have to do. Mm-hmm. So just from my perspective, talking to people, that seems to be a more long-term issue with systems. Even if they're not fit for purpose now, they might not be for a very long time.
I think there's a big future for the utilities, actually. Yeah. I mean, so if you were to develop your operating model today from scratch, I would say, and let's use a few company names, I'm going to use Open Gamma, right, to price my pre-trade stuff. I'm going to use Cloud Margin to deliver the margin. I'm going to use Acadia Soft for the messaging. I'm going to use Trioptima for compression. That's a beautiful model. That would work wonderfully. But where Barry's firm, for example, now, and the asset management community currently sit, they've got 25, 50, 100 years of history. The associated systems, the clients and mandates that you've picked up over time. So to get from the current model to that beautiful model, it's a million miles away, and it's in terms of, just doing the gap analysis would cost fortunes, much less implementing those changes. So that's where I think the utility may well come into its own. So the Barclays deal with Sunguard being one good example, and I know Calypso are working on something similar. So I think there's a big future for that.
Okay, so we'll probably see more of that in 2006, no doubt.
I think so, yeah, definitely.
Now, moving on to the next point, the adaptability of the markets. Now, you've just alluded to this with utilities. Let's talk a little bit about how the market has evolved so far. I know we've talked about swap futures, but do you envisage the market kind of continuing to evolve in the next year in light of these new requirements and these challenges?
I put a comment on LinkedIn last week about blockchain being the most frequently word used of the year, I think. I'm not going to profess to understand it whatsoever, but I think we will see some really interesting developments, you know, utilising that technology in time, and that could be a real game changer. You know, it could completely revolutionise what we do and how we do it, and actually make things much simpler than it currently is. Adapting, I mean, Barry kind of said earlier that we've known this regulation was coming. We've sat back, perhaps not done as much as we could. But if you had, let's say you had implemented a new collateral management system, 4 years on, the market has developed and advanced so much that...
I think one of the biggest problems, though, in terms of people moving forward has been certainty over what it was we were being asked to build by when. So, you know, I think collectively as an industry that this has dragged on too long. You cannot be in a state of flux with reg change. Let's not forget the G20 initiative was September 2009 with an end date of 2012, end of 2012 at the latest. We are at the end of 2015 heading into 2016 and we're still not there. The ability of firms to resource and fund multi-year regulatory projects is a problem. We cannot continue to have things in project forever. But I think just coming back to in terms of the market evolving, it's slightly off topic, but I think it's very pertinent to this. The response from ESMA in terms of pushing for, one of the things that they came out in terms of the EMIR review was that really in Europe we need something akin to the CFTC no action letter. I think that's, you know, as I say, it's slightly off topic, but things of that nature in terms of the market evolving, I think that's absolutely crucial for us to get something like that in Europe, so that people, we have had a degree of regulatory forbearance from all of the regulators. For example, coming back to Eugene's point about EMIR reporting, everybody knows that has been very difficult. It's still not brilliant. It's getting better. There has been regulatory forbearance, but no regulator in Europe would come out and say openly, don't worry, we're not going to take any action on this. That's where the no action letter really comes into its own and gives the market clarity that for a certain period of time, they know that they can fix the things in the background and no action is going to be taken. Now, in terms of, coming back to things like the reporting, in terms of having that conversation with clients saying, we believe the regulators will take no action, but there's nothing we can give you concrete, you know, that's concrete to back that up, because we would never get a regulator to write on a piece of paper, don't worry, I won't take any action. What they might say in private to you might be slightly different, but as I say, I think that's, for me, that's a really crucial development, and I think that really needs to come about. So.
Okay. Yeah, and I can see how that would help enormously. As you mentioned, various different projects on the go at a given time, you can prioritize, and then you get that clarity that you need in order to move forward. You know, we've talked about the evolution, but I want to focus a little bit on electronic trading, so the electronification of OTC derivatives. And Eugene, focusing on you first, really, how do you see electronic trading kind of evolving in the next year? I mean, we've seen it already with CEFs, and it hasn't really happened in the way that people anticipate in terms of volumes. What do you predict?
But I think it's an interesting one. So, because obviously, look, electronification again. It's back to the carrot stick scenario, right? So CEFs and trading, you know, made available to trade on CEFs, etc., is all because the regulations have said it must be done that way. But then actually what you then had on CEFs is that, well, you kind of trade off CEF, but then you report it on a CEF. So there's so many different variations on a theme there. I kind of have this conversation, though, a lot at work, because I kind of feel it's a little bit, it's the death of the salesman, a little bit electronification. The model is changing, and I think we do have to face facts that everything is moving onto electronic platforms. And so when I say the death of the salesman, I basically say today salespeople are phoning up, they're talking ideas and all of those kind of concepts. And then and so what would happen today is a client would say, great, give me a price. Now they would then go to their trading desk and they'd say, what's the price? They would come back with the price and then they might do it. Now it's all going to be done electronically. They might still give them the idea, and then they'll ask them to execute it on an agency basis and then take more of a commission. So I think we are going to see the activity moving much more onto electronic platforms, and we see that through, as you say, the growth of these types of platforms in Europe. Now, look, I know there are so many CEFs registered in the US, and I'm sure some of them are doing de minimis types of volumes. But I think it is a natural evolution of products moving into the electronic space. I can say that from our perspective, from a Commerzbank perspective, of course, it's a great area of focus. What's the word? Digitalisation and those types of things are very much where we see the future. So that's where we will be looking to kind of grow and support our business. And now, what do we remember? That's actually from an execution side. Obviously, myself, I'm from the clearing broker side. And then, therefore, from a clearing broker point of view, we have to make ourselves ready for this as well. That drives in partly with the trading on the OTFs, to then being able to have the appropriate limit management processes in place. Looks like it's going to go away on the ETD space after the recent announcement. But on the OTC space, you're still going to have those pre-trades. So there's still a lot of work to be done around that. We have the US, at least, as kind of a copy. But we have to wait for the European rules around MiFID and MiFIR to come into place to really be clear on what we will need to do in Europe. But in summary, it's going electronic. I truly believe that.
And more to come as it evolves.
Yes.
The next couple of years. We got to focus on clearing first as well.
But I think you're going to see an emergence of new trading opportunities there, because if you look at the kind of basis between CCPs that will emerge, I mean, quite recently there was a CME swap clear basis. And that's going to be, when you electronificate that market, people can trade in and out of that stuff all day long. So you're kind of, from a regulatory perspective, deleveraging the OTC environment, but introducing, new ARB opportunities, if you like, for, algos, HFTs, for example. So it's going to be very interesting.
The only thing I'd add to that is my reading of the European rules is they're slightly more flexible in terms of what an OTF can do. It doesn't necessarily have to be all electronic. And I think that's important where potentially we do need to generate liquidity. Just putting stuff through electronically doesn't necessarily generate the interest in the market to trade.
I mean, what it generally does, it's just smaller scale, but smaller notional, more higher tickets.
Yeah.
But yeah, you're right, wouldn't it? Yeah.
Yeah, I mean that's another point. That's a really good point, Ricky, about the potential reduction in actual trade size, and a much higher volume of lower notional.
Yeah, although you mentioned algos and HFT, but there's regulations coming out around those and disclosure. So you find a little chink and you cover it over to try and something else opens up somewhere. So I think that's
what futures argument.
Yeah, exactly. There's always going to be a process to try and adapt to those.
It does seem to kind of summarize the last few years in my mind, whereas you seem to tackle one area of the market and then some other kind of consequence. I mean, you mentioned the repo market drying up, for instance. One thing has to compensate the other. You address one challenge, another one props up, and I think that's a problem with the regulators. In the sense that they have to address this just as much as market participants do, and kind of. That brings me to a quick question here about how the market has changed in the last few years. I mean, it seems like there's a lot more collaboration, but there's still that tension in terms of challenges versus expectations. How do you guys see the market has changed in the last few years, for better or for worse?
Well, it's definitely changed. What I find most interesting is that there is, and I'm not necessarily for a good reason, there is more talk about the back end pieces of things than really where is the market, where is the economy. Capital markets is about economies. It's about supporting industry to generate wealth as a broad line statement. And I feel that kind of topic of conversation, that's just gone. The focus within banks and within the buy side and with everybody is not about wealth generation as a whole. It's just about, I've got to deal with this next, I've got to deal with that next, and so on. So I think the market has changed. The sentiment of the market, We all are very, and this is definitely not for the wrong reasons, we're very conscious now of this very much compliance culture that, as I said, for all the right reasons, that, you know, we have to be focused on that. So I think there has been a very big shift in the mindset and the focus of the capital markets industry. I mean, you talked about collaboration and the us and them. There's been a lot more changes of working together. And actually, there was two earlier on this year. I think there was, I won't say groundbreaking, but so you had head of CFTC, so you had Massad and you had Lord Hill, basically make a joint statement about where they were on equivalence and when they hoped they would resolve it. Now, it hasn't been resolved, but again, this is about the regulators trying to be open with the market so that we don't get caught by surprises. And similarly, at the same time, Lord Hill came out and he said, we expect clearing to be in place by April of 2016. Now, 2 years before, you'd have never got any kind of a statement like that. So it is clear that the relationship and the symbiotic way that, you know, the regulators and the industry itself must work together is being better understood in terms of an ongoing basis.
I would say that buy side, sell side, all utilities, everybody's been working together closely on this, which I think is a brilliant development. We're all effectively pulling in the same direction, batting pretty much for the same things. I think the downside, the big change that I think has been really negative in all of this is the fragmentation of global markets. Mm-hmm. We've gone from, you know, really trading these things anywhere with anyone to effectively being regionalised at the moment.
Yep. And that comes with, you know, if you're a large asset manager and you're facing the US entity of a US bank, that comes with a redrafting exercise of all of your ISDAs for 200, 300, 400 clients. You know, extreme expense, and what really is the benefit to the regulator of that exercise having taken place? None whatsoever. But it's a tremendous burden on the buy side to manage. I mean, one of the most perverse things in all of this, I guess, is Solvency II says, Barry, you guys need to use more derivatives. You have to use more derivatives. And then EMIR says, do you know what? I'm going to really punish you, capital-wise, for using more derivatives. And that can't be the intention of regulation. That's not, to my mind, how things should work. You know, so is that an unintended consequence? And I think we've spoken before. There's definitely a desire to deleverage the marketplace, but it has to be to the appropriate extent that the underlying risks are still managed.
Well, I think, unfortunately, it's probably more that these regulatory developments are taking place in separate silos, mm-hmm. and the question is who's pulling it all together at the top level.
Yeah. But that's to be fair, it's not a sentiment that's new either. No. I think, and at those highest levels, it's continually communicated to them. And I think the fact that you had ESMA come out with that statement that it wanted to work with the European Commission on its next drafting of papers, etc., so that it didn't have this, we'll send it to you, you then sit on it and review it, and then we'll send it back with all of our comments. Mm-hmm. We'll actually work together so that when you send it to us, it's in a state that is going to be agreeable to us as the European Commission. I think those are examples of where they are trying to be more efficient in achieving
and they
objectives.
have now also, I mean, you know, the regulators are really taking a more consultative stance with the users.
That I do agree with, yeah.
So that can only be a positive thing, and that's probably on what, its 20th iteration now, isn't it? I believe.
Well, the other thing I'd add to that is in terms of the PRA, people at the Bank of England reaching out to us as an asset manager. I mean, that under the old regulatory regime, that would never have happened. Mm-hmm. Consulting on both sides of the market to really understand the impacts on end users.
Seems like that's a positive change, despite despite everything that everyone's working on. Final question for you today is 2016. So here we are, end of 2014 or 2015. Sorry. what, to each of you, what is your main concern next year, or what would you really like to see happen within your own firm or within, you know, the industry at large? And starting with you, Ricky.
I can answer that in 2 words: leverage ratio. It has to be. It has to be appropriate. They have to. If you can get the relief for segregated margin, which is, it's almost common sense. It's so obvious. It's common sense. I can kind of see why in their initial drafting they wanted capital preserved against that as well. But you know, in an individually segregated account, it's fully protected, and the people that this really affects are the long-dated, balance sheet intensive users. You know, building societies, insurance, life insurance, pension funds. Probably the most secure investor there is. So to make it so punishing for them is, it was not just unfair, but it actually makes the business, you know, economically unviable. And I'm sure it's not the regulator's intention to push people away from hedging risks within those portfolios. So it's, for me, leverage ratio, if they get that right, it changes so many things.
Perfect. What about you, Eugene?
I've kind of stolen my thunder, so which I guess was
It's
always,
it's clearly a very important
always
concern.
inevitable was, yeah. But look, I mean, what have we got to look forward to or to expect in 2016? Well, what we have to remember is, yes, we finally expect clearing to come into play for at least Category 1 and Category 2. We also expect the bilateral, the BCBS, IOSCO, for kind of the Tier 1 to come into play. And then you've pretty much got to be ready for MiFID, because it's going to come into play at the beginning of 2017. So suddenly what you actually see is, once again, there's going to be a huge regulatory preparation focus to get ready for all of those things. And to the comment you made where you said that the buy side tends to follow the sell side, I would strongly say that in terms of what is going to happen in the BCBS IOSCO. Because ultimately, that Category 1 is actually a very high threshold. I mean, those are your truly, truly global dealers. So they are going to set the standard. They're going to set the working model as to how it's going to be. And so it's going to be very important for everybody else to follow that, follow it very closely to understand how that's then going to impact them when they reach the appropriate phase for themselves as well. So I think, you know, once again, there's going to be too much regulatory focus in 2016 rather than, again, the business generation, the wealth generation.
Great, thank you. Barry?
Our focus will firmly be on, to Eugene's point, getting our Category 2 clients prepared and ready for mandatory clearing, because we know they get caught by front loading. It makes no sense to us to continue to trade bilaterally, knowing that we have to bring those things into clearing. It just gets very messy. So that's one thing. Again, the bilateral rules, we've been reaching out to banks trying to understand what their approach is going to be to this, because we all know that we need to make changes to the existing ISDA documentation. Also, we have a number of accounts where we don't collateralise FX today, and all of that activity will need to be collateralised under those rules. But again, focus on the whole regulatory piece is really where we're at.
More of the same.
Yeah.
Great.
Yeah.
Well, thank you for sharing your insight and expertise with me and with our audience today. I really appreciate it. So we've covered quite a lot of ground, the challenges that we already face, the ongoing challenges that we face next year, but hopefully this market will continue to evolve and innovate in a way that encourages more growth in the OTC market. So thank you again for joining us, and I really appreciate it.
Thank you.
Thank you.